The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everybody. This is AJ Brown with Trading Trainer. If you can hear my voice, please raise your hand raising button. Or I should say, please click on your hand raising button. In case you don't know where it is, take a look at your webinar software. There is an orange button with a white arrow on it. And below that button is a few other buttons. The one at the bottom of that vertical array of buttons is your hand raising button. In fact, will everybody just click on it just to see if I can see your hand raise right now? Excellent, excellent. I always like to make these webinars very interactive. I will be opening up a Q&A area at the end if you've got some questions. What I do ask is that you have a couple of sheets of paper to take notes and a pen or a pencil, a pen if you feel very confident to take notes. And if you have any questions along the way, jot them down on your paper so that when I do open the Q&A box at the end for you to type in questions, you'll be ready. The other thing I would suggest is the makers of the webinar software like to put the webinar software like right in the upper right hand corner of our screens and on the right side. And for us traders and investors, that's the business end of our charts. So they do give us a way to minimize the webinar control panel, and that is that orange button with the white arrow on it. So if you click that orange button with the white arrow on it, it will squeeze that webinar software off your screen, freeing up the valuable screen real estate, especially in that area that is most important to us during this webinar. And if you click it again, it'll bring it back. So don't fear, it's not gone for good. It's just gone temporarily. You can toggle it back and forth, back and forth. You'll also want to, one of those buttons in that vertical array, not the bottom button, that's your hand raising button, not the top button, that's the one that toggles on and off the webinar software. One of the ones in between will make my screen full screen. And I am going to show some detailed thinkorswims, spreadsheets, things like that on this presentation. So you may want to look at it in full screen so you're not having to squint to see it. How many with the show of hands think that's a good idea? Excellent. So now I can see how many of you know where that hand raising button is. Good. So the only other thing I want to say is I am taking a moment to do this presentation. It's got all updated examples. It's new and improved. And because I have invited you to my webinar instead of being part of somebody else's like multi-speaker event, I can take my time with you and really get the details across. A lot of times with some of those other events where I give a presentation similar to this, they cut me off and I have to rush. So I'm going to take my time with this so that you can really follow along to make sure you understand the 3 simple steps to generating a 7-figure income. Sound like a plan? Good. Let's go ahead and begin. So this is a particular important graph that I want you to have deep in your psyche. I want to point out a couple of things. We're going to revisit and really deep dive into it towards the middle of the presentation, but I want to embed it in your presentation now. I want you to notice a couple things. This is the 0 or break even line right here, this line that goes across here. And what I want you to notice is there's a gray and an orange line. They don't go up linearly, they go up exponentially. And I want you to notice that the gray line only spends less than about 1 cycle. By the time it gets to 2, it is now above break even, right? So I want you to kind of notice these things about the graph. Let me get my chicken scratch off the line there so you can see that. I want you to notice this graph and really follow along because it's going to make sense as we get farther along in this presentation. So let's go ahead and continue here. So let's start off with a simple little exercise people have done this for years. I've been seeing this exercise presented to me for over 20 years now. $50,000 today or a penny that doubles every month? Which would you take? Let's go through the penny exercise. So getting into a week, into the month, our penny has doubled to 64 cents. You know, this thing is nowhere near $50,000 and we're already a week into it. But I do want you to notice kind of the exponential growth, because that's a very important piece of this puzzle. And as we keep going, we're at day 10, about a third through the month. We're up at $5.12. As we keep going, we're about 15 days, about halfway through the month. We're still at $163.84, nowhere near $50,000. As we keep going, now we're 3 weeks into it. The month is pretty much about 3/4 of the way done. And as you can see here, we're at $10,000, almost $10,500. Finally, at day 24, which is about 2/3 of the way through the month, we've beat our $50,000. And as we get towards the end of the month, we skyrocket exponentially. At the end of the month, we're at 21,474,836.48. The key here, though, is we grew exponentially. And we had to go through that first 24 out of 31 days of pretty active management of our positions just to get to a point where we broke even with the $50,000 bag of cash, and then it grew from there. So the question is are you prepared? Do you have that compounding in mind, or are you here for instant gratification? Right? Because there's plenty of programs out there marketed for really pinging anybody who has an instant gratification bone in their body, right? And most of them, in fact, I haven't found one yet, and I've been looking for 25 years, will take your money, and then it turns out that the program is not quite attainable, right? The instant gratification is just that, kind of a pipe dream, right? So I want you to be on the same page with me that we like the long haul, we like the investment, and we're looking to earn better returns than just putting our money into a risk-free account. This is because of compound interest, and it's been attributed to Albert Einstein. He thinks it's the most powerful force in the universe. Now, I'm not sure that Albert Einstein completely said that. It's been attributed to him, but it's still a very powerful sentence, right? Here's where I want to break it down for you. If we focus on growing our portfolio by 6% every month, our investment will double every year. That is 6%. That is compounded 12 times, not compounded continuously, but compounded 12 times monthly. And that's how we can get to doubling our money every year. So if you had $1,000, that means in 12 months, it would grow to $2,012. Or in 2 years, it would grow to $4,048. Or in 5 years, that $1,000 would grow to $32,987, almost $33,000. And in 10 years, you'd be a bona fide millionaire. You'd be at a million, almost a million point one, right? Here's the other good point about focusing on 6% per month. If you have a $100,000 portfolio, that means every year that $100,000 golden goose would generate $101,219.65 per year. That's more than the mean salary in the United States, which is $87,000. And the best part is this is your money working for you. You're managing your portfolio, spending about 20 minutes an evening, rather than having to work what an $87,000 per year job goes along with, which is about 50 to 60 hours per week. How many of you with a show of hands have heard of me before or know of me? Okay, good. Quite a few of you. I'm going to just breeze through this. Let me ask the opposite question. How many of you with a show of hands, this is your first encounter with me? Okay, most of you know who I am. I founded this company called Trading Trainer back in 2003. I've been an active equities and options trader since 1997. I've been publishing my daily insights for my Trading Trainer participants since 2002 every night. I've made ebooks, I've made home study courses, and I'm an engineer by discipline. I've got a degree in mechanical engineering. I've got a master's degree in automatic controls. I've got backgrounds in commercial business and investing. And what I've taken on in the last 15 years is also becoming a practitioner of accelerated learning methods, being able to teach people using out-of-the-box techniques, ways to learn things even if they think they're too old to learn new tricks. And just to make sure you understand where I came from, in 1997, I started by spending $27,000 on seminars that first year. I've pretty much spent that much every year since. But in that first year, not only did I spend $27,000 on seminars, in fact, these were back before webinars. We had WebEx, but that was only offered in corporations at that time. We weren't doing much on the internet in 1997. So I was attending Saturday seminars at hotel conference rooms. How many of you with the show of hands remember when we used to go visit hotel conference rooms on Saturdays to learn about trading and investing? Quite a few of you. In fact, how many of you with show of hands remember that you'd spend the morning there or you'd spend the afternoon there, and then they'd try to get you to spend more money to spend the Sunday there? And then if you really liked it on Sunday, they would have you spend even more money. You'd have to fly somewhere to spend 3 days. That was a very interesting marketing model for those folks back then. Now you do it all by webinars, right? Not only did I spent $27,000 on seminars that first year, but I did give $85,000 back to the market that first year, making stupid investments, trying to follow all those different programs. In fact, how many of you with the show of hands want to know what, just in the beginning here, what the secret is to battle that little situation? Because I'm sure if any of you have bought any programs in the past and tried to follow it, you probably had a very similar experience where there was quite a few losses combined with the expense you spent on those programs. The answer is I cornered the same schleps that I was seeing every weekend at the water cooler. And I said to them, you know how we always got a 15-minute break? I said, do you want to do these programs together instead of me battling it on my own? And they all, of course, jumped at it. I mean, if anybody is suggesting to organize something like that, everybody else will participate. And that turned out to be the turning point for me. Sadly, I didn't figure that out until 1999, 2 years into my losses. But I'm giving you a shortcut here. Give me one moment. Just going to turn off this phone application. Make sure I'm completely present with you right now. Okay, I apologize. So the key is if you go in with a group of folks, not only will you look over each other's shoulders to make sure you're doing the program correctly, right? If one person is doing something completely different than the other four, then obviously that one person is out to lunch. And they'll get immediate feedback before any losses are incurred. But also you'll have, number one, the accountability, because a lot of times we won't keep following through, especially in those first days when the learning curve is so exponential. We won't keep following through on those learnings until we get our breakthrough. When you have other people who are counting on you to show up on a phone call or in an email chain, the success is going to be much higher, right? The other component, of course, is there's so many people out there who don't think that investing works. And they will plant little seeds into your mind and tell you that investing doesn't work. And when you have a loss, those voices in your mind will tell you that investing doesn't work. The scoop is when you get on the phone or get on the email chain with 4 or 5 other people who are in the same boat as you are, you can erase those words that really have negative effects on us. So consider that. Consider joining in with family members, joining in with other people in your neighborhood, friends, even people you just meet on a bulletin board. That was my turning point. So just a little tidbit there. My most important thing in my life is my inner city gangbangers. So I have started a foundation. I started it at the same time as I started Trading Trainer in 2003. In 2003, I took 9 inner city kids. I started with 14, and I'll be completely transparent that 5 of them completely washed out of the program. But the other 9 kept going. It was a 6-month program, very similar to what I'm doing now. The only drawback is they were limited because they did not have computers or internet connections. We had to do it at a public library, and they only were allowed 30 minutes of access to the computer and internet per day. So these kids with, I would say probably a 4th grade education, even though they were all in high school, they were kind of like the kids left behind, and 30 minutes of internet and computer access a day, all of them were able to be successful. At the end of the 6 months, I gave them each $2,000 of my own dollars. I figured I was just going to write it off towards charity. I'll have you know that each one of them paid me back. They all wound up buying their own computers and at the time getting DSL connections. One of them wound up putting himself through Denver University, and they're all very successful today. We've kept rolling this program. We have since moved it from Denver to Chicago, and we have partnered with the Chicago Board of Options Investing, the CBOE. And we brought last year over 170 Southside Chicago kids in for this same training. So this is my passion, is working with these inner city kids and giving them an alternative. All right, enough about me. Let's get going. Let's remind ourselves what I was talking about with respect to the 6%. What minimum returns must you make monthly on your portfolio to more than double your money annually? Do you remember? Is it 0.5%, 1.5%, 5%, 6%, 10%? Please click on your screen to let me know that you remember the answer. I see that about 20% of you have already answered on the screen. Go ahead and click your screen, pick the answer, and then click submit. Now we're up to 45% of you. I'll leave it open for about 20 more seconds. If you haven't replied yet, please get off your rusty dusty, grab your mouse, and give it a click. I'll give you 3, 2, and 1. So it looks like the majority of you that answered did remember, 61% of you saying that it was 6%, and that's exactly right. Now, just to let you know, we focus on 6% here at Trading Trainer, but the truth is right now our group is making between 10 and 16% per month. I keep track of the folks who do coaching with us to see what are their actual returns. So even though we focus on the 6%, the 10 to 16% is what is coming our way. I guess it's like aim for the moon and you'll hit the stars or something like that. All right, these type of investments, and I call them investments rather than trades, and you'll see why in a moment. These ones are less subject to wild swings or devastating losses. They're definitely immune to downturns, like what we've seen over the last couple of weeks. Can be structured to profit from downturns. In fact, we can flip them upside down. They have built-in profit buffers. In fact, the profit buffers can be structured upside down. And the key is the last bullet point. We focus on earning more than 6% per month on our investments. So what are we actually investing in? What I've always been a focus on is selling option premium. So what the heck is this thing called option premium? Well, when you take a price that you can look up on the CBOE, like if we were to, for instance, take our Thinkorswim here and just pull up a option chain, like for instance on Ericsson, you can see that there is a current price for any of the options. This price, for instance, this September $4 call is going for $4 right now, right? Well, that $4 is made up of two components. We call it the in-the-money component, and we call it the premium value component. That option price is equal to the in-the-money component and the premium value component. If it's not in the money, then this thing is 0. If it's out of the money or at the money, it's 0, and then the option price is equal to the premium value. But there is these two different components in every option price, and they behave differently. some of you might be saying, okay, AJ, I'm on this call, but I don't even know what an option is. Well, it's a financial instrument called the derivatives. Calls came around 1970s and puts came around in the early 1980s. They're bought and sold to hedge risk against stocks, indexes, and exchange traded funds, but that's not how I'm using them today in this program. Instead, I'm focusing on selling premium. And I focus on 4 simple transactions. This is a good way to get started as an investor in selling option premium. Covered calls, covered puts. This is where we flip the covered call upside down. And then you'll see here an example where we take the covered call, and instead of doing it against a underlying symbol, we supercharge it by selling the covered call against a leap. And we can also do the same thing with our put. In fact, I want to star this one because, as you know, these are like sisters. These two, the covered call and the covered call against the leap is a sister, covered put and covered put against leap is a sister. But I want you to pay attention to this covered put against a leap because it behaves like the covered put, but, and I'll get to this more later, this is a margin trade, and this one down here is a cash trade. These other two are cash trades as well. Why do I care so much about cash trades? It's because I use these strategies, and I recommend you do as well, in your tax-free accounts. This is something where you take the nest egg and you grow it and grow it and grow it. This is your retirement program. And if you have a nest egg, like we said, of $1,000 right now, in 10 years, you'll have $1 million, right? If you have a nest egg with more than that, you're going to be in better shape, right? Even faster. The key here is in your retirement accounts, whether they be your RRSPs in Canada or your IRAs in the United States or whatever your retirement program is in whatever country you're in, the tax-free accounts typically have to be cash trades. So we want something that behaves like a covered put. Here's our alternative. Not only does it have a lower cost basis, but it's a cash trade. We'll talk about that more in a second. So let's go through an example. Now, this example is for General Electric, okay? And I want to put I'm doing this example for you right now in a way that we call a buy right. This is where we do the 2 transactions right after each other. Now, why am I telling you about this buy right? And why am I giving you kind of a disclaimer? It's because we take it the next level in our program. We actually leg into it. And that means we get better returns, and even better, it means we get lower risk. But I wanted to do this simple example with General Electric with you on the phone in a buy right because it's really easy to understand. Just know that we do better by about 4x than any of these by using a strategy called legging in. With that said, here we go. If we were to have bought GE at 957 and then sold the GE September 10 call at 30 cents, we would get what's called an instant dividend of $30 per every option contract sold. And that's because option contracts have 100 option shares rolled into them. So it's an instant dividend. And what we're looking to have happen is for this premium to wind up expiring worthless. In other words, it's like when a supermarket gives out a coupon, it actually behooves them for you to never use the coupon. That's why they put an expiration date on the coupon, because then they put out a marketing thing to get you into their store, but if you never use their coupon, they get to save the money. It's kind of like a coupon. It's kind of like, if you think about it, I'm buying GE, and then because I sell this coupon against it, I'm buying GE at a discount. A couple of different ways to think about it. So let's go through the example. If GE closes above $10 on September 20, that means that we paid $9.57 for GE. We get $10 back for the exercised call. That gives us a profit of 43 cents. And in addition, we get to keep that 30 cents for selling that call against GE in the first place for a 77-cent profit, which is 8.3% return on investment. What if GE doesn't go up above $10? What if it's flat? So you pay $9.57, you get your 30 cents. That means you had 30 cents of profit to date, which is 3.2%. And then we're going to do it again every single month. This is the actual ideal situation. Of course, again, we're going to leg in, so we're going to get better prices than this, get better returns every month. But the idea is it's kind of like renting out a piece of real estate and collecting the rents every month, but I don't have to worry about tenants, trash, and toilets because what I'm renting out is my underlying stock. Now, what if GE drops by September 20? Well, built into this is what we call a profit buffer. I have 30 cents of profit built in that buffers me from losses. In other words, my break-even price is $9.27. So that's kind of a good thing. Now, stay tuned because I'm going to show you in about 10 minutes how we collar this position, which protects us even further. But even built into the inherent trade, we have these profit buffers. Here are some examples. We made 17% on Micron in 12 trading days. That's when the stock traded up. We made 15% on Activision in 34 trading days. That's when the stock treaded water, went sideways. 14% on Allscripts in 86 trading days. That's when the stock took a dump. Okay, let's answer all that apply. What does investing by selling premium create? And I want you to answer all of them that apply. Does it create an instant dividend? Does it create a discount on a security? Does it create a profit buffer? Does it create an expiring coupon? I'd like you to go ahead and click on all the ones that apply, hit submit. I'll keep the poll open for a few moments here. All right, I'm going to give you about 5 more seconds. 4, 3, 2, and 1. All right, let's see what you guys said. If you answered them all, then you're right. When we sell premium, we get an instant dividend. We also basically get a discount on a security. We get our profit buffer, and it acts like an expiring coupon. A couple more real trades. 21% on Caesars Entertainment when the stock went up. 12% on St. Joe's when the stock went sideways. 17% on Community Health when the stock took a dump. Now, this is a question that I'm going to ask you before we talk about it. How can we lower our investment, increase our returns, and even convert a margin trade into a crash trade? Now, I kind of hinted at this earlier, but the answers I'd like, and I only want you to select one here. And if you have to guess, guess. There's nothing wrong with getting it wrong because I'll just give you the right answer. Should we sell farther out in time options? Should we replace the security with options trading at parity? Should we just give up and start buying mutual funds? Or is what I'm talking about not even possible? Please answer now. Should we sell farther out in time options? Should we replace the security with options trading at parity? Should we give up and buy mutual funds, or is what we're talking about not even impossible? Not even possible. I'm going to give you about 5 more seconds. 4, 3, 2, 1. And I'm absolutely excited that I asked this question. And the reason is because the answer is replace the security with options trading at parity. And if we take a look at what people were guessing, it was almost 50-50, but it kind of weighed a little heavier out on people thinking we should sell out in time options. So we've already had a pretty awesome learning moment. If you sell out in time options, meaning instead of selling September, let's sell October or November to make more money, you're actually screwing yourself. So please make sure you take a note on that. The way that options decline in value is exponentially with time. And so, for instance, we call the most recent option, like for instance, right now it would be our September option, the near term option, and then we have the 1 month out and the month out after that. The longer we stay involved in a trade with the same option premium sold, the more time during that commitment, because when you sell premium, by definition, you now have a commitment. You now have the obligation to get exercised. The longer we're in that obligation, the more that could go wrong. And as you can see here, the amount of gain we get for those 2 extra months is very much smaller than the gain that we get for the near term month. So when you're selling premium, put this in your notes, when you're selling premium, always sell the near term option. The cost benefit for selling farther out in time in options is not there. In fact, it's dangerous and you're putting your portfolio at risk. How many with the show of hands follow? Good. Good. So the actual answer is that we want to replace that underlying security with an option trading at parity. Now you might say, well, what the heck are options trading at parity? Option premium is the most when the option is at the money. So that's the other thing you want to do. When you sell your near-term options, you want to sell the at-the-money option. The at-the-money option is also going to give you the most bang for your buck because that's where option premium is the most. However, when we go deep in the money, the premium actually decays off. And what's left is that intrinsic or in the money value. So when we want to replace that underlying symbol with a stock replacement, an option, we will go deep in the money so that we get an option that moves exactly like the underlying security, dollar for dollar. Only we'll be paying a cheaper price for it. And in the case of the covered put, we'll be creating a cash trade out of it instead of a margin trade. So When we're selling parity, we go near term at the money. When we are finding a replacement, we go deep in the money. And how far out in time should we go with that replacement? Let me give you some statistics. I already told you that right now, our participants that are following this program to the T are earning 10 to 16% every month on their money. But what are some other statistics? Well, another statistic is the trades, the positions, are lasting on average 5 months. Now, I'll be completely transparent. It's a fairly flat bell curve, which means that there's also quite a few positions that are lasting 7 months and quite a few that are lasting 3 months. But the majority of our positions are lasting on average 5 months. The other thing that I can tell you is that 3 to 7 positions is what it takes to vet your whole portfolio, whether your portfolio is $1,000 or we have quite a few participants that have 8-figure portfolios greater than $10 million. You can invest your whole portfolio in 3 to 7 positions. 3 to 7 positions that each last roughly about 5 months, earning 10 to 16% per month. And what this translates to is 1 to 2 new positions required per quarter, per every 3 months. So if you think about that, having to search or having to find 1 to 2 new positions every 3 months, this is not an active trading strategy. This is a portfolio manager strategy. This is where we like to watch and check in with our portfolio on a nightly basis, but we take very little action. And on every third Friday of the month when options expire, or if you're doing weekly options every Friday, you collect the paychecks and you reinvest it. And it's just as if you were a Wall Street portfolio manager, but you're managing your own portfolio. This is not a lot of active trading. In fact, we don't do anything with this particular program during trading hours. We do all of our analysis end of day, and then we program our conditional trading rules with our brokerage software to happen during the day while we're off doing other things. Back to the question at hand, how far out in time should our substitute options expire? Coming back to this particular statistic of our positions lasting 5 months, maybe going as much as 7 months. I had one about 1 year ago, September 2018, that went 9 months. The one that I had back in 2011 went 14 months. But let's say, we want to do it for 7 months. The last thing you want to have happen is have your back month stock substitute expire. If you're collecting rents on something every month reliably, the last thing you want to have happen is have that something that you are collecting rents against expire on you. How many with the show of hands follow? So we want to go far enough out in time so that we won't have that happen. Imagine like you have a rental property and you've got a tenant in there, and for 3 years you've been collecting rents and it's helping you, supplement your income, and then all of a sudden the property just disintegrates on you and you can't collect the rents anymore. That's kind of what would happen if you don't pick a far enough out. We buy our back month option far out in time so the substitute option expiration will not interfere with selling many cycles of premium. We typically use leaps. In fact, right now we're playing with 2021 leaps, right? That's far enough out in time that we don't have any worry that those things are going to expire. So again, substitutes that trade at parity are deep in the money. and we go far enough out in time that their expiration won't bother us with collecting many months of premium. So we could pay $9.37 on GE, or if we want to find an option that's trading at parity, we can do the GE 2021 Leap, $5 strike price. It only cost us $4.80. A little more than half. Now again, I'm going to show you a buy right, $4.80, 30 cents for selling the call, instant dividend of $30, but now the $30 is on a much smaller investment. What happens if GE closes above $10 on September 20th? Well, we're going to get cashed out of GE at $5. You might say, well, shouldn't we get cashed out of GE on $10? We do get cashed out of GE on $10, and then because we have the $5 strike price on the back month, we get to keep the difference. So we get $5. That gives us an immediate profit of 20 cents, plus we get the 30 cents that we got for selling the premium in the first place. Total profit is 50 cents. It turns out we get an 11.1% return on investment. Not bad. What happens if it is flat? Just like before, we get to keep our 30 cents, and we're going to go and do it again and again and again and allow it to compound. And what happens if GE drops by September 20? Well, we have that 30-cent price buffer, so it can drop all the way to 450 and we won't even realize it. Here's a couple of the trades that we did using this strategy. 43% on Yandex when the stock went up, 90% on Guess Jeans when the stock treaded water, and 2% on Bloomin' Brands when the stock took a big dump. All right. Now for the third part of the puzzle. This is the third step. By the way, are the first two steps clear? Before I ask you this question, how many with a show of hands are following with how we sell premium and then how we sell premium supercharged by using something other than an underlying stock? You following along? Show me with a raise of a hand. Excellent. So now let's do the next piece of the puzzle. The next piece of the puzzle is how can we drastically reduce our return on risk? Should we sell half as much option premium? Should we sell out-in-time options? Should we collar the investment by marrying a protective option? Or is what I'm talking about just completely impossible? What should we do to drastically reduce our return on risk? I'm going to give you about 5 more seconds to click on the screen, pick an answer. I'll give you 3. I'll give you 2. I'll give you 1. Let's see how many people pick collar the investment by marrying a protective option. Almost all of the people who answered. That's fantastic. Let me show you a real live example. I'm going to bring back my Thinkorswim here. And I'm going to pull up a chart on Ericsson. Now, I actually have been following a trade on Ericsson since October of last year. Now, there was a moment here where I jumped out and jumped back in. So the first trade lasted about 4 months, and now I'm about 5 months into the second trade. But I'm going to show you my trade log, kind of point out some of the cool parts about this. We started off buying Ericsson on November 23rd. I bought 1,100 shares. I paid $8.30 a share, as you can see here. But what I want you to pay attention to is this cost basis, right? And I bought that, if you take a look at the date, November 23rd. Here is November 23rd. I bought it when we were at the low of a tested channel. As soon as we hit a high of that same tested channel, that's called legging in. On December 14th and on December 17th, I sold that premium. So I sold the December 9 call. I made 20 cents on selling that. And then I bought myself a January 8 put, okay? And I paid a nickel for that. Now, when that option expired, December 21st, I wound up getting to keep that 20 cents. That premium just expired away. It's like I sold a coupon and nobody used it, and so I got to keep the 20 cents. I waited for the next low, which was 12.26, and for 25 cents, I sold back that protective collared put. I didn't need it anymore. I didn't have premium. And then what did I do? I rinsed and repeated. So on January 10th, I sold my January premium. I bought my February protection down at $8. This time I sold my premium for another 20 cents. I bought my protection. I didn't get as good a deal. I didn't get a nickel. I had to pay 20 cents, but that's fine. What happened on January 18th when it expired worthless? Well, it did just that. Nobody used my coupon. I got to keep the 20 cents. And then at the next bottom, January 24th, I sold back my insurance for a nickel more than I paid for it. So I want you to, for some of you that are investment kind of experienced investors, experienced traders, I want you to notice that not only am I making money on selling premium, but I want you to pay attention here, because in addition to making money on selling premium, I have also turned the insuring of these positions, the protective insuring of these positions, the collaring, into a profit center rather than a cost center as well. In other words, I'm making money on both ends. And my position is protected every time I've got premium sold. You can see over here the next time on March 9th at a high, we sold our premium for 50 cents, and that's when we started to break out above the channel. I knew I was going to get exercised. I didn't need to collar it, and sure enough, I got exercised. Then as soon as we established a channel up here again, you'll notice that we started to channel all over again. I started the process all over again. I bought the $1,100. I just changed what prices I was, instead of collaring at $8, I'm now collaring at $9, and I'm selling the $10 premium. And I've been doing that ever since. In fact, we're at this point now, and you might be saying, well, what about here? This thing has taken 2 months of drops. It absolutely has, and that's where my protection has kicked in. If you'll notice, our puts, for every dollar that we drop below the value of our collar protective puts, our protective puts chip in $1 towards the position. It lowers our cost basis. So even though the underlying stock is all over the board, we're following it along with our position. Here's what you got to pay attention to. Notice the cost basis, how much per share we're currently into the trade for. Notice what happens right after the first month. After the first month, when we're in the second month of selling premium, our cost basis is $7.93, $7.73. It pops back up to $7.94 when we insure it, $7.70, $7.20. We're insuring it down to $8. Now think about that. What happens if you're insuring something for more than it's worth? In fact, take a look over here. We're insuring our position at $9. Our cost basis is at $7.85. Even now, we're insuring our position down to $8. Our cost basis is down to $6.77. When you insure or collar your position for greater value than it's worth, What is that called? And that happens naturally with these positions 1 or 2 cycles into the trade. So what is that called? What do we have when our cost basis, our break-even price, is less than our protective bailout price? What would we call that? Is that called a risk-free investment? Is that called a losing trade? Is it called too much complexity, or is it called a crack pipe dream? What do you think? The minute our cost basis dips below our protective bailout price, our collared price, what is it called? Please answer now. Just click on the screen, click submit. Risk-free investment, a losing trade, too much complexity, a pipe dream. I'm going to give you 3. I'm going to give you 2. I'm going to give you 1. The answer was a risk-free investment, and as you can see here, most of you picked up on that right away, right? So that's a beautiful part about this strategy. Now, coming back over here, let's bring back that chart that I showed you in the beginning, where we had this break-even price. This is the chart for Ericsson. And again, despite Ericsson blasting above its initial channel, then dipping down below its initial channel, these are the returns. And because every month our cost basis gets reduced by the profit of the previous month, our gains are not linear. In fact, it makes so much benefit to us to allow these positions to run as long as possible, because as you can see, the gains become exponential. ROI, return on investment, is equal to the amount of profit we make over the amount of money invested. Every month, the profit goes and reduces our investment. In other words, we keep having the numerator go up and the denominator go down. It creates an exponential gain in our portfolio. And as you saw, right within the first cycle, we no longer had a risk in our position. It became risk-free. In fact, the gray represents what happens if the trade goes against us, and the orange represents what happens if the trade gets exercised. Notice that 3 or 4 months in, the difference between the returns we get if we get bailed out or get exercised is so small. We don't even care if the trade goes against us, because, I mean, really, what's the difference? 90% ROI or 85% ROI? I'll take either one of them. And this is where we kind of change our mindset from being a directional trader to allowing the portfolio to just make money as time passes by. So that's the power of this graph right here. I wanted you to really drive that home. So let's review the 3 steps. We'll bring our webinar to a close here. I want you to, step 1, buy or short an underlying security, or buy a substitute option that is trading at parity. Next, I want you to sell a near-term at-the-money option for its premium value, an instant dividend, and profit buffer. And then I also want you to collar that position with a married option that is 1 month out in expiration to protect your investment. 5 major points I want you to walk away with. Number 1, right now, especially since the end of 2017, in January of 2018, we officially ended our Trump rally. And we've been going sideways choppy ever since. And the sideways choppy, if you haven't noticed, has gotten very volatile. Right now, if you're doing just stock replacement strategies with options, if you're interested in doing directional trading with options, you better, number one, be a very active trader. And number two, it's going to be a numbers game, and it's typically a sucker's bet. It's not about your win-loss ratio. It's going to be knowing how to do risk management. It's becoming very difficult right now. The market is saying sell premium more than it's saying trade directionally. Point number two, you can generate a serious income selling option premium. Number three, you can insure your position for up to 20 times the return on risk. Number four, we hunt for these trades with a sniper rifle, not a shotgun. And lastly, I have found in doing these trades for over 25 years that it's very difficult to screen these opportunities by hand. In fact, I'll show you what my program participants use. If I go to tradingtrainer.com, this is our main public website. I suggest you all visit the tradingtrainer.com website if you haven't yet and bookmark it, especially for the articles. I like to write white papers that are helpful for the public. The last I wrote was comparing and contrasting learning how to invest to a skill. How will AJ's favorite book, all this good stuff, right? I'm going to go ahead and log into our members area so I can show you what we use. So this is where our members are, and here's our premium selling program. And we have screeners. And when the screeners run every night, and they tell us what symbols to look at, including sample positions. We also have new screeners that I've been working on. Like for instance, here is the screener for yesterday with different symbols we should be pursuing, right? My screeners go through 11,670 something. That was the number last night. I check in on the statistics. Underlying symbols, and then over 900,000 related options, right? There's a whole bunch of options for every symbol, and it looks for matches. It looks for where there's premium, it looks for where there's patterns, and these screeners pare down the over 11,000 symbols, stocks, indexes, ETFs, to the ones that have the best bones, the best probabilities, and it really simplifies our task. So I would recommend using a screener rather than you'd spend a lifetime trying to find these candidates by hand. All right. How would you like to never miss a pick, minimize the amount of time you spend away from your loved ones, and have support whenever you need it? Because that's what my program's all about: saving time, creating clarity, and getting results. And my next question is, would it be okay if I just take a couple of moments at the end of this call to tell you a little bit about my materials, my training, and tools to see if you might be interested in them? Is that okay? If so, raise your hand. Excellent. Thank you. So the program's definitely for someone who doesn't want to pay for multiple data subscriptions, wants everything they need in one place, doesn't want to miss an opportunity, wants to spend more time doing other things than sitting in front of the computer trading, doesn't want to do this alone, and wants the step-by-step instructions. In fact, what it is summarized up is someone who wants to get consistent, reliable results. Like Charlene. Charlene's my favorite example. Charlene wrote me this email in the middle of the night. What she was saying was, hey, I was a teacher for 29 years. I got sick. She got cancer. And she pushed through as long as she could in the classroom. Chemo was getting the best of her, and they finally ordered her out. They literally ordered her out of the classroom. She had 13 years left before she could get her pension, her full retirement from the school system. She thought she was going to die, and she was totally peaceful about it. But then here, and this is what bums me out about our current health system. She had a recovery, and you would think that that would be the best thing ever. Oh my gosh, I didn't die. It turned out that it sucked. And the reason is because now she had medical bills and she had no livable retirement coming in, and she wasn't going to be able to collect her Social Security for 10 years. So she got interested in the stock market, and the rest was history. She met up with me. I showed her this same program that I showed my inner city income kids. All she does is read a daily table, finds a stock she's interested in, follows the strategy set out for her. I use this along with other strategies to diversify my financial plan. I recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. It was so easy. So let me tell you what the program has with it. And I can actually show you in the website too. You get to be part of a once-a-month live training webinar. So every month after the third Friday of the month, I bring everybody on and we have a webinar where we take one piece of our process and we really do a deep dive. And it's usually a piece that people are having issues with. But what it does is it creates for us, as you can see here when I go back to our homepage, here's the premium selling learning replays. This archive, if you wanted to go through and pick a piece of the process, you can Google, you could search this by keyword. You can get an in-depth, almost encyclopedic rundown of the exact step of the process you're in. And so this makes it really good for reference, right, when you're trying to learn. But here's the even more exciting part. You get to be part of a once-a-week webinar workshop. And these workshops are every Thursday. In fact, we have one tonight at 9 p.m. Eastern Time, 6 p.m. Pacific Time. And this is where the folks that have been in the program for a while, they offer up screener picks from our screener that they've done some vetting on to make sure that they're good picks for right now. They offer them up in our webinar live, and Coach Jay and I, one of the premium selling coaches, will take the tickers and screen them, like look at them with everybody on the line so that you can get an idea how we pick our best candidates, which ones we're looking for, what qualities. It's a real learning opportunity. But then after that, we take the candidate and we run it through. We have a premium selling worksheet that we give everybody. And all you do is you type in the numbers on the configuration page that you pull out of your broker software. You just fill in the blanks. And then it does your risk management and your plan creation depending on which strategy. Remember, we talked about the 4 different strategies: the covered call, the covered put, the covered call against a leap, the covered put against a leap. And it writes these plans for you that tell you exactly what to do. It makes it really easy. And what we do with those is after we have our workshop, we post the replay. And when we post the replay, you have, like, for instance, last week we did Hess. The week before that, we did RTN, then Bank of America. Then we did Hewlett Packard, Cisco, American Airlines, back on and on, right? All of these are tradable candidates. And what we do is we give you not only the video you can watch on how to set it up, here's the download of the different worksheets, but we also give you the exact configuration and plans so that you can go and take the trade yourself, right? That's the whole idea. Is if you're just starting out, we want to have you learn one piece at a time, and we want you to learn while you're earning, right? Earn while you learn. We don't want you to have to spend 6 months figuring out how to do this. We want to spoon feed you some trades that at least you can follow in your paper trading log to see how they work out while you're learning. How many of us show hands like that idea? Every Thursday we do this. Okay. We have a place where you can ask your questions. So right here, we call it our community forum. And we go in there, and when you ask your questions, we will automatically answer it as quickly as we can. And this too is searchable. As you can see here, this too is searchable for you to find answers to your questions. In fact, you might find out that you have a question that you didn't even know you had when you start looking at our forum. And as a bonus, we have 2 bonuses for you today. One of them is we're going to put together a strategy session with one of our coaches. So in addition to being part of this program, we're going to let you talk to one of our coaches about where you are right now and where you want to be and what is the fastest way to get there. And by the way, all of our coaches have been on the same paths, right? They know how and what steps you need to take to get to where you think you should be. They'll also give you a double check. Like for instance, a lot of people, you'd think a lot of people over exaggerate where they want to be. And we have to tell them, hey, pull it back some. It turns out it's the other way around. A lot of people underestimate where they can be in 6 months, 1 year, 3 years. And we have to say, you know, you should think a little bit bigger than that. We also have a double your money back guarantee. I've had this guarantee on all of my programs since we started here, and that is try the system. Do it for the 6 months, the same amount of time as my inner city kids did it, same amount of time as Charlene did it. Try it for the full time. If you're not showing a profit at the end of 6 months, not only will I refund your money for the program, I will give you twice. So I will give you your money plus the amount for just trying the program. So it's kind of a no-brainer, right? So here's what we're going to do. You go right now. The website I set up is called optioninvesting.org/special. In fact, I'm going to pull up that website right now. In fact, I'll put it into the chat area. Optioninvesting.org. Let me just copy and paste it from here. Copy into the chat area, paste. There. So you can click on it right in the chat area, or you can jot it down, optioninvesting.org/special. And what you should get to is a page that looks like this. It explains more about the program. It emphasizes the double your money back guarantee. The price of the length of the program is 6 months, and the price of the program is $497. The other besides the free coaching session that we're also offering if you want to break it up into payment plan. So instead of one payment of $497, we will take 3 monthly payments of $177. So if you wanted to break it up, you can't do $497, then just do $177. So you can see that that just popped up on my screen. Either way, it's an amazing, especially with the double your money back guarantee, it's an amazing offer. Do not pass go. Do not collect $200. You deserve it. Aww. Your loved ones deserve it too. You can also reach me by sending an email at aj@tradingtrainer.com. You can call me by dialing this number. I'm at extension 87. And I am going to open up the Q&A area. I asked you in the beginning of the call to type in any sort of questions or write down any questions that come along. So I can spend about 15 minutes answering any sort of questions while the others of you check out optioninvesting.org/special. So I have opened up the Q&A. If you have collapsed your webinar control panel off the screen, by pressing the orange button with the white arrow, you can click it again and it'll bring the webinar control panel back. And you should find that there's an area where you can type in questions if you have any sort of questions. First question just came in. I have a portfolio of $800. Is this program worth it? That's a great question. I have had folks do covered call writing with portfolios as low as $500. In fact, as I pointed out, I gave my kids $2,000, which is a small portfolio as well. Yes, the program will work. My big thing is, you know, if you can't afford the $497 or the 3 payments of $177, if that's stretching you thin, realize there is a learning curve, and you have to, it's not going to be instant gratification. I can't emphasize that enough. This is not a get-rich-quick scheme. But $800 is doable. There will be some limitations. In other words, when you're at the low end of the portfolio size, you'll be stuck with smaller priced securities to begin with. Some of the other securities that you'd like to get into, you may not be able to afford. The same thing happens on the upper end. When you start to have portfolios greater than $500,000, it's not that you can't afford anything, you can afford everything. It's that we now have a question with liquidity. So the real sweet spot is a portfolio around $10,000 all the way up to, say, $250,000. That you can do anything with that portfolio. When you get bigger, it's somewhat limiting. When you're smaller, it's somewhat limiting. But is it doable? Absolutely. Here's the next question. Do you have a sample portfolio that people can follow along with? Absolutely. In fact, you can follow along with all of those positions that we have in the replay area of the portfolio workshops. We like to set those positions up and we like to follow them along. I came in at half an hour late. Can I see the whole thing again? Absolutely. We're going to have this available by replay. Do I need to change brokers? I use IB. No, you don't. What I do, though, I like option analysis software. It makes our lives easier. And there's different companies that offer option analysis software. If you want to go the free route, you go and you open an account. I'm not saying you fund it, because they don't require you to fund it. I've had an account with them for years, and I've never given them a penny, with TD Ameritrade. And you can then download the Thinkorswim software package. It's not the best, but it's pretty nice, and it's free, right? You just open up a account and don't fund it. And then once you've got that account open, download the software, and you use that for your analysis. Then you can use whatever broker you like for trading. Great question. I bought an October put on the Spider, which is losing money right now. How can I lessen the loss? It's called an adjustment trade. And generally, it's very difficult to adjust a trade. It's better to set it up correctly in the first place. And if you're selling October premium on a Spider, it's already not set up correctly. With that said, just remember these points. When you're adjusting a trade, we like to adjust our trades in times of peace, not in times of war. That means if you're going to add collared protective puts or collared protective calls or whatever type of position, You want to do that when the position is going your way. If the position is going against you, then adding positions or trying to adjust the position only adds insult to injury. You're going to rack up commissions, and it's almost better for you to liquidate the position, take the loss on the head, and then learn a better way to set them up in the first place. So that's kind of the knee-jerk reaction. A lot of people think that there's a magic way to turn a losing trade into a winning trade. A lot of times the answer is, and I'd have to look specifically at your trade to give you other suggestions, but a lot of times the scoop is liquidate it, get into an all cash position, regroup, and then don't make those type of trades again in the future, right? Any other questions? Here's another question. Is the 497 for a year? No, the 497 is for a 6-month program. And it's not a recurring charge. It's a one-time charge, or unless you do the payment plan, that's 3. But you're not on recurring billing by any means. At the end of 6 months, of course, you're going to get an automatic email that says, would you like to continue? But nothing is on automatic billing. We don't save your credit card, nothing like that. How long is it going to take me to learn? That's a great question. It differs per person, and mostly not on education, because the education you need to comprehend this is like that of a 4th grader, right? Somebody who's 10 years old. What it comes down to is commitment, right? And if you come to the Thursday workshops and also watch one of the replays, the workshop replays, if you commit to coming to a live one and watching the workshop replay every week, you will pick this up in 2 to 3 weeks. You'll be on your way going. If you decide that and the more that you watch, because what you'll find when you come to these workshops is we've done the same exact process every week since 2007 when we started this program, right? This program's been going this long, and we've created quite a few success stories out of it. If you decide to put the minimal effort in there, it's going to take you longer. I've had people also who have picked it up after just 1 week of just delving in and going through all the material. But I would say set aside about a good month, and then set aside the rest of the 6 months, the 5 months, to just going through your process, repeat, repeat, repeat. And I always recommend starting this stuff with a paper trade account so that you can see that it works. And then, maybe around month 2 or 3, after you've repeated, and you're getting good at doing this stuff, managing this portfolio, you start substituting in real trades. My retirement account doesn't allow long call options to be collateral for short options like in a credit spread. Oh, that's Keith. And I think Keith was in either my full-time program before, or maybe you did this premium program before. I'm not sure. I remember your name, although Keith is a pretty common name. Keith is pointing out that these covered calls against leaps, the actual academic name on this is called a diagonal debit spread. So if you're an academic person who likes to be nerdy like me, then you know that that's called a diagonal debit spread, right? So in order to sell a call option, I have to buy the stock, or to sell a put, I have to have sufficient cash in the account to cover expiration. Can I obtain 6% a month with these restrictions? The answer to that question is absolutely yes. In fact, the way that the risk works out, Keith, it turns out that the position sizing for the covered calls against the leap have to be a little bit smaller. And so you can definitely make the 6% per month you could definitely hit those targets. The other thing I recommend is, I know that people, especially people that come from a generation, and I'm not saying this is you, Keith, but there are people out there who have gotten attached to their broker, just the way that they used to get attached to their employer, right? With pensions and stuff. Oh, I'm going to be here for 20 years. Here's the truth. Your broker doesn't care about you, just like your employer doesn't. And I know that there's been some stuff just in the last 2 weeks where corporations supposedly are coming to the point where it's not all about investor return, that they're going to think about their employees, but that's just been memos. I haven't seen anything about that. So lawmakers have made it possible for us to move our retirement accounts with 0 fees from broker to broker, and they've made it possible to happen overnight through ETFs, through electronic exchanges. And so one other option, and I know this is going to kill some of you who love your broker, if your broker has restrictions or doesn't have the tools that you want to have access to make this type of portfolio work, or whatever limitation your broker has, shop around, because you're not trapped. So that's another suggestion. Keith says, you are correct. I have been with you before. I think you have probably improved your site. That's absolutely right, Keith. In fact, not only that, we have, in addition to improving our site, we're releasing new screeners and a new kind of planning tool that's going to be online. Right now, our planning tool is available, as I showed you, on a spreadsheet, but we're going to make it so that people can do everything from within the web portal. And we're making some leaps and bounds here and Trading Trainer with the type of material we have available. So, are there limitations trading from an IRA with this program? From Phil. The answer to that question is no, not from a government defined, these are the limitations of an IRA. However, depending on who you have your IRA with, brokers have a tendency to put their own limitations on IRA accounts that are above and beyond what is defined by law from the government. So with that said, make sure you shop around, especially if you're with a broker that was around, especially in the 1990 S&L crisis, right? There are a lot of brokers out there that have just come recently, like since the most recent depression recession crisis. And then you'll see the ones that came around before that, and then you'll see the ones that have been around since hammer was a hatchet. The S&L crisis was the big one that really had lawmakers focus heavily initially on options. So you need to check in on that. Like if it's a Fidelity or a Schwab, they might have more limitations on what you can do with your IRA than, say, for instance, one that's brand new, like a Trade King. Okay. And again, even if it's just moving a small portion of your IRA to one of these more option-friendly brokers, you might consider doing that. But that's like step 10. I wouldn't worry about that until you've got this program under your belt, right? Start with a paper trading account and see how this program works, gets the nuts and bolts, gets yourself into the habit of checking into the markets 20 minutes in the evening, somewhere between market close and the market open the next morning. Get yourself into doing this portfolio management. It's a lot less than having to actually do live trading. You know, when we do directional trading, it's very few minutes, but I want you to get the program down. And while you're getting the program down, you know, search for the right broker for you, right? If it's not your current broker. But, you know, let's make sure we're worrying about the important stuff first. And in this, it's actually learning the program. Keith says, I will be joining, just need to check my finances. Fantastic, Keith. I appreciate that. And the only other question I see here is, oh, I think it's the same question as before. How long is it going to take me to learn? So there you go. I think that we came to the end of our time. How many of you, with a show of hands, picked up something new this afternoon that you didn't know before? Excellent. Excellent. How many, with a show of hands, picked up something this afternoon? It wasn't new to you, or it might have been new to you, but now you have a much better idea how to wrap your head around it, how to really think about this a little differently, especially the part about turning the collaring or protecting of your position from a cost center into a profit center to actually benefit the economics of your position. Yeah, yeah. And how many of you, with a show of hands, just plain old enjoyed yourself this afternoon? Please visit optioninvesting.org/special. Check out our offer. Remember, you can do one payment of $497, or if you'd like, split it up into 3 payments, 3 monthly payments of $177. There is the double your money back guarantee. If you have any questions, I'm available at aj@tradingtrainer.com, or you can just call us here at the office, 970-266-8146. My personal extension is extension 87. Everybody have a good rest of your afternoon. Take care.